Let's start with a thought that usually lands quietly but sticks. If volatility keeps showing up in markets, maybe it's not the problem. Maybe our reaction is. That's what this walkthrough helps solve. As we move slide by slide, notice where you usually rush, panic, or overthink, and where one small shift could steady everything. And if this kind of thinking helps you, subscribing keeps you sharp. We unpack ideas like this every week. Now, as we land on the opening slide, Mastering Volatility, Strategies for Market Uncertainty. That quote, "Volatility is the price of admission," sets the tone. It's asking you something simple but uncomfortable. Did you expect growth without movement? Many investors secretly do. That mismatch creates stress. This is also where the PDF comes in. It's there to slow you down and help you reflect later. The link's in the description. Moving into the agenda slide, notice the order. First, why volatility exists, then how resilient investors respond, then tools, and finally your personal playbook. This matters because most people jump straight to tools. They hedge before they understand. They copy strategies without context. Does that sound familiar? If so, this structure fixes that by design. As we reach the next slide, volatility is the market speaking. Here's the key idea. Price swings aren't random noise. They're information mixed with emotion. Fear, surprise, herd behavior. All of it shows up in candles and charts. If you've ever sold just to feel better, that wasn't strategy. That was emotion-seeking relief. This builds on the agenda's first promise, understanding before action. Taleb calls this being aware of randomness instead of fighting it. Now the slide on what volatility really means. The first point says it's movement, not permanent loss. That's where most people mess up. They confuse discomfort with danger. The second point explains why: news, sentiment, surprise. Ask yourself, which one triggers you the fastest? Headlines, social media, a red portfolio notification? And the third point, volatility often spikes before recoveries. This is where patience pays, but only if you're prepared. Buffett's quote fits here because risk isn't movement. Risk is not knowing what you own. Flowing into the historical pattern slide. Crises repeat. The names change, the emotions don't. 2020. Fast drops, slow thinking, then recovery. The mistake listeners often make is assuming this time is different, not because of data, but because fear feels new every time. This slide reinforces why the previous definition matters. If volatility is familiar, you don't personalize it. You don't panic sell history. Next, diversification as defense. The first bullet reminds us uncorrelated assets soften shocks. Simple idea, rarely applied well. Many portfolios look diversified, but move the same way. That's the trap. The second point anchors it in math, not opinion. Markowitz didn't say diversification makes you rich. He said it keeps you alive long enough to compound. And the third point, stability without sacrificing returns. If you've chased returns and lost sleep, this slide is calling you out gently. Graham's wisdom fits here. Safety first, ego second. Now we arrive at time as the shock absorber. Short-term swings fade. That's obvious, but still ignored. Why? Because screens refresh faster than patience. The slide's second point, long-term averages, only work if you stay invested. So here's the thinking question. What has historically pulled you out early? Fear of loss or fear of looking wrong? Lynch's line reminds us, the market doesn't beat most people. Their emotions do. As we shift to the inner game of volatility, this is where many listeners realize the issue isn't strategy. Loss aversion makes small drops feel catastrophic. The second bullet, rules beat emotions, is where you fix that. Do you actually have rules or just intentions? And the third point, calm decisions compound. Sounds simple, but it's rare. Kahneman explains why. Your fast brain hijacks your slow one. Journaling, pauses, even waiting 24 hours, those aren't soft habits, they're performance tools. Moving into hedging and protection. This slide isn't telling you to become an options trader. It's reminding you that asymmetry matters. Small protection, large relief. The mistake people make here is either ignoring hedging completely or overusing it out of fear. Ask yourself, are you avoiding this because it's complex or because you're uncomfortable learning something new? Natenberg's work fits because it reframes volatility as something you can structure around, not just endure. Now the actionable takeaways slide. Each bullet is intentionally small. Track indicators weekly, not hourly. Rebalance one position, not the whole portfolio. Automate contributions, remove emotion. Write before reacting, catch yourself in the act. If you try to fix everything at once, you'll fix nothing. Which one of these feels slightly uncomfortable but doable? That's your entry point. As we pause on the reflection slide, this is the quiet check-in. When markets shake, do you tighten or adapt? Most people tighten. They stop learning, stop adjusting, stop thinking long-term. Holiday's quote fits because obstacles don't disappear, they redirect you. Volatility is the same. It exposes weak plans and strong habits. Now the conclusion slide. Volatility is not the enemy. It's the test. If you master your response, growth follows, not just financially, but mentally. The second PDF CTA is here for a reason. Reflection after emotion fades is where insight sticks. Grab it from the description and actually use it. Finally, a quick word before we close. If this walkthrough helped you see volatility differently, calmer, clearer, more strategic, subscribe to the channel. We break down complex ideas into usable thinking without hype. Markets will keep moving. The real question is whether you'll move with intention next time.